What if you could, as an investor, learn what behaviors are holding you back from being successful and change those so that you can think more about it from a numbers and an algorithm standpoint rather than an emotional standpoint? Do you think that would make you a better investor? I definitely do. So does Dr. Richard Smith. And that's what we're talking today about on the Fearless Investor Podcast. Hey, welcome into the Fearless Investor Podcast. We've got a great show for you today, something that I'm very passionate about, which is behaviors and understanding human behavior. But before we get into that, I have two requests. Number one, if you have not already followed us on Instagram, make sure you do that at Fearless Kyle, posting a ton of content and a lot of stuff, especially about current Airbnbs and flips that we have. A lot of great information there that you can learn from and connect with me, DM me. I'm always looking to connect with people. And then number two, if you have not already subscribed to our YouTube channel, please do that. We're getting so close to 1,000 subscribers. Would love to see that number go up and would love to be able to have you continue to digest our information. And again, just like I always say, conquer the world of investing. So today we're talking about conquering your mind, conquering your behaviors, understanding more about your behaviors within investing so that you can really change those behaviors from emotional to factual, like just doing things based on numbers, based on algorithms, based on things that are supposed to be done with investing. But so much of us have this emotion attached to investing and we end up making the wrong decisions because of our emotions. So Dr. Richard Smith is going to talk to us today about that here on the podcast. Hey, welcome in everyone to another episode of The Fearless Investor. You're listening to me, Kyle Stanley, and we've got Dr. Richard Smith, the self-proclaimed doctor of uncertainty with us today. And he's also the future author of The Risk Paradox, which is a couple months out. But Dr. Smith, thanks for being with us today.
It's great to be with you and your audience, Kyle. I love the title of Fearless Investor. I think that's very apropos to what I'd love to talk about.
Yeah, we're gonna have some fun with today's topic. I love talking about what makes people tick and their behaviors, and that's exactly what we're going to dive into. But before we do, you have been investing for a long time. You've been the head of some companies, so there's probably tons of stories that you have. But what's one that sticks out to you for your most interesting or I guess strangest investing story?
My strangest investment story. Well, I don't think this is that unusual, frankly, but it's my kind of baptism by fire. I first got started investing 98, 99. I'm finishing up my PhD in the mathematics of uncertainty. I'm supposed to know a thing or two about risk and be a numbers guy. And I did run my account up about 300% in about 12 months. And, was about to get married in June of 2000 and ready to tell the in-laws, don't worry about it. I got the wedding expenses covered, you know. I'm a real man. And then March 2000 hit. And I found out that there was a lot more than just theory to risk management.
Yes, the .com.
And what took me 12 months to accumulate took me about 1 month to dissipate.
Oh my gosh!
And that was a wake-up call, a wonderful wake-up call to have right out of the gate. When thankfully I didn't have a whole lot of money to lose, and I have been. I would say, fiercely pursuing an understanding of the markets and how to help people do a better job in the markets ever since then, including myself.
So who paid for the wedding?
It was a joint effort. We all kicked in.
Good. That's awesome. Well, hey, thanks for being on the show again today, Dr. Richard Smith. I appreciate you just sharing your knowledge, and I want people to understand exactly just how much knowledge you do have. There's a lot more than just a resume there. Bring us up to speed on your story. What got you into what you're doing today? What are you doing today? And also, just anything that our audience needs to know about you.
Yeah, well, so I have a PhD in the mathematics of uncertainty. And my dissertation was on how to help scientists and researchers be more honest about the uncertainty in their own models and forecasts, and not put in false information that isn't really warranted, so you end up with conclusions that you don't really have a clear picture of what the likelihood of those conclusions happening or not happening really are, right? And So I kind of jokingly earned the moniker of Doctor of Uncertainty after I finished my PhD. But I really came to embrace that title because I think that so much of successful investing and speculation is ultimately about having reasonable expectations, and being able to kind of quantify your expected gains and what you need to risk to achieve those gains. And I just think, it's really pretty low hanging fruit for most people. I know there's a lot of, mathophobes out there that think that they can't do math, but this is pretty simple stuff, and there's tools available to help you do it if you can't do it on your own.
You've got a calculator,
And
you can
it's
do
just
math.
so important to have good expectations and good kind of reward to risk ratios. And I just think there's tremendous ways that people can do that. And I think that the fact that most people don't do that is what leads to so many of the, misunderstandings and unfortunate outcomes when it comes to investing and speculation. So, really what I kind of discovered over my 25-year career now is that investing is probably more of a behavioral challenge than it is an information challenge. The information's there, the tools there, the data's there. The final frontier, the last mile, if you will, is human behavior.
Now, before we go into that, because that's really what interests me and what I want to dive deep into, but you keep using the word investing. What kind of investing are we talking about? All investments?
Yeah.
Is there specific ones that you teach or that you have, made your money in? Can you share that?
Yeah, I am passionate about helping individuals invest in the stock market. And my particular focus is on helping individuals to build their own portfolios of individual equities and to build a portfolio of 15 to 20 good investment ideas that are not correlated to one another. So Ray Dalio famously said that the holy grail of investing is 15 good uncorrelated investment ideas. And I think that is an achievable outcome for individual investors in the stock market. And I don't think that it's really widely available, the education and the technology to help people do that. So that's been my focus. I've developed a kind of systematic approach to that over the years. And it's certainly coupled with a lot of emphasis on behavioral finance and behavioral psychology, because, the key to successful investing is consistency and execution.
So give us an example. What would be an uncorrelated investment? You said 15 different types. Well, what are two ones that are completely uncorrelated?
I mean, off the top of my head, I might guess something like Walmart versus a junior gold mining stock.
Okay. Very different.
And if you put those two together, they can actually be, greater than the sum of the parts, right? So, because ultimately what it's about is you having a smooth ride up in your portfolio, right? So, if you're invested, say, exclusively in technology stocks, right? Those stocks are going to be highly correlated with one another. They're going to be going up and down at the same time.
Right.
And you're still going to have these kind of amplified moves in your portfolio. And those are kind of hard to stomach sometimes, right? So if you treat your portfolio as a whole, and if you have, they use the word diversified. I use the word, I use correlation, and it's a mathematical tool, right? So, a highly speculative, biotechnology or junior gold mining stock can actually kind of dampen the volatility of your portfolio overall, even though it's a very volatile investment. Because if it's uncorrelated to the other investments that you have, then it'll be going up while others are going down, right? And you'll get a smoother ride going up. And, this is such simple, basic mathematics. And yet, almost nobody uses it. I mean, the professionals use it, but they have risk management departments and they have back office assets and, risk managers who are looking over their shoulder. So There's just so much low hanging fruit here, Kyle, to be able to help people to begin to use, simple tools of risk management that, anytime somebody says, where's the alpha in the markets, Richard? It's like, well, it's in risk management and it's in understanding your own behavior.
That's great. So, I mean, the things that I'm hearing right now that I really want to point out are that people really think like investing is risky. The people that don't understand it, they think it's risky. The things that you're talking about right now, you're talking about algorithms, you're talking about behavior, you're talking about things that we can control and make it a less risky investment. If I'm making sense of that correctly.
Investing is risky.
Okay.
And that's a good thing.
Yeah.
And my upcoming book, The Risk Paradox, is about exactly this point. Okay. You cannot get rid of risk. Okay. If you want to put your money under the mattress, go for it, man.
Mm-hmm.
You have the risk of inflation destroying your capital, right? Same with the money in the bank right now.
Right.
So there's no avoiding risk. People try to avoid risk. And by trying to avoid risk, they actually achieve the very risks that they're trying to avoid. So let me tell you the most powerful illustration of this paradox. Okay. So 2 Nobel Prizes in economics have been awarded now for a very simple observation that we hate to lose.
Okay.
Daniel Kahneman in about 2002 or so, who along with Amos Tversky is the founder of prospect theory and behavioral finance. Popular book out now, Thinking Fast and Slow. Good book if you haven't read it.
Okay.
And then more recently, Richard Thaler, who was Daniel Kahneman's student. He's now at MIT. And he has a popular book out too called Misbehaving. Great book. And Richard Thaler kind of added to Daniel Kahneman's work that, yeah, we hate to lose and we're always trying to get back to break even. Okay. So the fact that we hate to lose has different consequences depending on if we're losing on an investment or if we're winning. Okay. When we are losing on an investment, the fact that we hate to lose makes us not want to sell, because selling is losing in our minds, which is not really a rational position, but that's the way we all take it. We take it personally when an investment goes down in value that we invested in, as if it's somehow connected to our own personal judgment and not just the fundamental uncertainties of the economy and of investing and of the markets and of COVID and all these things that we have no control over, right? This is why I love the title of Doctor of Uncertainty, because this is not personal stuff, right? This is just fundamental to the fabric of the systems in which we're allocating our capital. It's not personal, right? This is how it works. These are complex systems, and sometimes you're going to win and sometimes you're going to lose. And that's part of being in the game. So when we are losing on an investment and we don't want to sell, okay? So in Kahneman's words, we are risk seeking. We seek to take more risk when we're losing. We're trying to avoid risk. We're trying to avoid losing, okay?
Okay.
But we are doubling down on those investments. We're not getting out of them. We have the sunk cost fallacy, right? So we're holding on to them for dear life. It's as though we really love our losers. We hold them so close to us. We cling to them.
The lovable losers.
The lovable losers, right? It's got to come back sometime. I got to get back to break even. You know, how many times have you heard yourself say that to yourself? I still hear myself say it to myself today, right? So we're risk seeking when we're losing. But when we're winning, the fact that we hate to lose attaches itself to our profits. And we become fearful, Mr. Fearless Investor. We become fearful of losing our profits. So we become risk averse when we're winning. Okay?
Okay.
So we have an urge to sell when we're winning. And we have an urge not to sell when we're losing.
Okay.
Okay. So the markets sometimes go nuts, right? 2, 3, 4, 5 standard deviation. events. These things aren't supposed to happen, right? You're not supposed to lose 40% in a month like we did in
Right.
February to March, right? It's not supposed to roar back, you know,
Which it
30%
has. It's
in
crazy.
3 months, which it has, right? So, because we are risk seeking with our losers and risk averse with our winners, when the market goes nuts, we get victimized on the downside instead of capitalizing on the upside. And that is, that's the reality of markets. And if you think that you can be in markets without risk, you will end up, realizing the very thing you're trying to avoid.
Okay.
Which is losses.
So I want to recap that really quick.
Yeah.
And I want to make sure I understand what you're talking about overall is the majority of people. Is that
Yes.
okay? All right. So when people are essentially, when they sell, they feel like they're losing, which is actually creating more risk. And when
it's creating more risk if they don't sell.
Okay.
They don't want to sell, so they're taking more risk. They're often doubling down, right?
Mm-hmm.
Tripling down sometimes, turning a short-term trade into a long-term investment,
right?
Redefining things, all in a futile quest to get back to break even so that they don't have to feel like they lost.
Got it. And then when they're winning and you're saying they're being risk averse because they're selling but they don't want to lose their profit. Is that that's okay? So
and Kyle, if you have a 90% loss, if you buy a stock at $100 and it goes to $10,
right?
You don't have a 90% gain to get back to $100. You have a 1,000% gain to get back to them. And, think about it as an investor out there, if anybody's listening. Have you had a 90% loss? I have. Have you had 1,000% gain? Not many.
No.
It's tough to endure 1,000% gain.
Yep.
Really tough, because you get very anxious about losing those gains. How could it keep going up from here? I had the good luck to buy Tesla at $415 back in March. It was one of the things I bit on when when we had the big downdraft, and thankfully I had some capital to deploy. And and then it's up 400% in what, 3-4 months, right?
Yeah, it's crazy.
And it became intolerable to hold on to it.
And so you
hold
sold
on to it anymore. I sold. Yeah.
Okay.
And I'm not unhappy about it. I sold 50% of it at 100% gain to kind of relieve the pressure on me a little bit. And then I sold the other 50% at a 300% gain. Okay. And I'm still not satisfied.
Yeah. Well, we never are, right?
We never are.
Yeah.
So anyway, this is what we're up against as human beings. And, I know that my kind of forte is the stock market. And that's where I've focused my efforts and my technology. But I think this is true of all speculative endeavors. And I think that life is much more of a speculative endeavor than people give it credit for. So
well, and so we just talked about the normal person and these feelings and emotions that happen that create them to either basically win or lose or sell or buy. Is this the correct way to approach it? Should they be listening to those emotions, or should they be using an algorithm, which I'm sure you have?
Yeah. Now, look, and part of the reason that I discovered this was because the first algorithm that I started with was a simple, humble 25% trailing stop loss. Okay. So I took my own portfolio from my experience as an early investor, where I went from $10,000 to $40,000 and back to $10,000. Okay. And I said, well, if I had just used a 25% mechanical trailing stop to decide when to sell, okay, buy the same stocks, buy them at the same time, just use a 25% trailing stop to decide when to sell. No emotion, right? No anxiety.
So just really quick, can you define what you mean by a trailing stop?
Yes. So if you buy a stock at $100 and you're using a 25% trailing stop, then initially the price at which you sell, if you buy at $100 and it doesn't go up a penny, it goes straight down from there, and passes $75, you sell at
Okay.
$75. Okay.
Got it.
But if it, before it goes down to 75, it might go down a little bit and up a little bit, and maybe it makes it up to $150. Okay. So now your 25% trailing stop loss is 25% below your highest point of profit. Okay. At $150 a share. So what's that? You're,
about 120, 115,
750 below that. So, about 115, let's say.
Yeah.
And, so that's a trailing stop loss. Okay.
Okay.
So
cool. Thank you.
At its simplest level, okay, remember we have this problem that we're risk averse when we're losing, and we're risk seeking when we're winning. Risk seeking when we're losing, and risk averse when we're winning. Okay. So a simple trailing stop will make you risk averse with your losers and risk seeking with your winners. Okay. So I applied this to my own trades, and I found that not only would I have been able to, not have nearly as much of the stress I endured trying to figure out what was happening and make up my mind, but I would have gotten out of the market with a 150% profit instead of giving it all back.
Wow.
And so that made an impression on me,
Absolutely.
Okay. So I still, I'm a big advocate of people deciding what to invest in on their own.
Okay.
I'm not an advocate of artificial intelligence. I don't want people to turn their decision-making over to machines.
Okay.
But I do want people to use algorithms and machines to enhance their own decision-making and to provide some risk management for them, right? So how long do you want to hold the stock for? How much are you willing to risk? And have a systematic approach to deciding, when to buy, when to sell, how much to invest, and how you put your portfolio together. And this isn't rocket science, and then follow it. And, from what I saw, all the back tests I've done, I've literally back tested thousands of individual investors' portfolios, and using even a simple approach like adding a trailing stop loss strategy improves performance in 70 to 80% of the portfolios that I back tested. The sad fact is,
wow.
In the UK and EU, they have some regulations. It's the ESMA regulations that make, at least in the Forex space, make brokers have to publish on their website what percentage of their clients lose money. Take a guess what the average percent is across 100 brokers. What percent of their clients lose money on average?
Gosh, I would say 60%.
It's 76.
Okay.
The low end is like 65, and
Okay.
the high end is 85. Okay.
Wow.
So, people, like I said, I'm a big advocate of individuals engaging in the capital markets. I think the capital markets need it. I think it's fun. I think it's a wonderful endeavor. But, people walk into this in a naive way, right? It's like you think that you can walk into, the MMA octagon and you haven't even been to the gym.
Right.
It's like you think you can learn to fly a plane by walking in out to the runway and hopping in a, fighter jet, pulling the stick back and expecting to survive.
Yeah.
That's the mindset that we come into this with, and we're encouraged in it by the media and by the brokers who make money off of our order flow and transactions and not whether or not we succeed. Right. And everybody out there who's trying to sell you a system telling you, hey, it's easy, come on in, it's fun, just give me some money and you're going to walk away with a fortune, and it just doesn't work.
Well, and this is the thing too, is that the one thing that does not have to be emotional for us is math. But for some reason, we all take something, we make it way more complex than it needs to be. And
Yeah.
before we know it, it's not an investment on math, it's an investment on how I feel. For example, I walk into a house and the comment is always, oh, it smells like money. Well, does it though? Or does the math tell you that you're going to make money?
Exactly.
And I really think that that's where, I got so many people when I got into real estate being like, careful, I know a distant cousin who lost his shirt flipping houses, or, hey, careful,
Right.
that Airbnb stuff, that's not going to be around forever. And,
Yeah.
all these people saying this stuff. And I'm like, yeah, but the things that you're doing are based on speculation. They're based on emotion. They're based on someone whose mind works completely different than mine. I'm very
Yeah.
analytical, and I
Yeah.
try to share with people that you have to be, if you're going to get in investing, if you're not good at numbers, you have to have the resources. A stinking calculator will give you the resource to be able to be good at math. And you
Yeah.
just have to look at the numbers and not look at how do I feel. And so, but why do
Yes.
you think, even when people are given that advice, why do you think people still default to how they're feeling?
I think because culturally, that's how we've been trained.
Mm-hmm.
You know, we live, for better or worse, in a consumption and consumer-driven economy, and all of the messages we've received since we've been kids have been targeted at our feelings, and really in manipulating our feelings
Mm-hmm.
to get us to buy things, or to have certain political beliefs, or to, you know, um, who knows what, right? So I just think we're kind of um, emotionally illiterate, if you will,
Mm-hmm.
coupled with being financially illiterate.
Yep.
Like the
100%.
financial illiteracy in the United States, in a country and an economy of this scope and success, right? To have people be so financially illiterate, it's incomprehensible. It just makes you wonder if this was somehow done on purpose. It's like,
Gosh.
it's so shocking
Yeah.
that it's like, why don't we invest in financial literacy? And it's not that much,
No.
Kyle. I mean, doing a spreadsheet, crunching some
Yep.
numbers, balancing your checkbook, a little bit of reward versus risk, a little quantification of things, all calculator stuff, just like you've said.
Yep.
So I just think we haven't been trained. I mean, actually, we have been trained. We've just been trained in the opposite way, in the wrong way.
Yep.
And we've been told from day one that our feelings are the most important thing. And we really haven't. Feelings are part of it. I've been asked about Robinhood a lot lately. Oh,
Sure.
they've brought 3 million new investors into the market. What do you think is going to happen with them? Like, well, I'm pretty sure I know what's going to happen with them. But at the same time, it's like 3 million young investors in the markets. How fabulous. Now, stick around for a little bit, guys.
Yep.
Especially you've got 30, 40, 50, 60, 70 years to make this work for you. Don't just take your stimulus checks and buy some options and, get burned by touching that hot stove and say, I'm never doing that again.
Right.
Like, take a little bit of time, slow down. Our capital markets, investing in real estate, this is a wonderfully fulfilling, and I would even say in the end, emotional activity, but emotions of success, emotions of pride, emotions of gratitude, emotions of providing for your family, not emotions of we and
Yep.
that you can basically go to Las Vegas if that's what you want to do, right? So
Right.
don't do that with the money that matters.
There's so many things you just said there that I have opinions on, and I know that most of you would agree with, but I think the number
Yeah.
one thing I just want to point out is, number one, if you did get a stimulus check and you spent it on an investment, first of all, kudos to you, because
Yeah.
most people are not. Most people
Yeah.
are, I have a lot of different friends who are buying stuff with it.
Yep.
And I'm just like, that's free money that was not supposed to be meant for a free thing that will only make you temporarily happy. It's supposed to be something that will help you to create something. And so
Really temporary. It won't last long, folks.
exactly. Yeah. So, I mean, and I didn't need, PPP money or EIDL money, but I mean, it's
Right.
there. And
Yeah.
even the highest percent interest rate was going to be 3%. I knew I could turn that into at least a 10% return. So why not use that money?
Yeah.
I'm not going to go use that 3% money and go buy, a jet ski or a boat or
Right.
put a down payment on something that's not going to pay me. But I really
You're in the
like,
minority, brother.
yeah, well, I know. And that's why I started this podcast, because I want people
Yeah.
to start changing the way they think.
Yeah.
But at the same time, I really think that it's tough to blame people for being financially illiterate just
Agreed.
because of the people that are teaching us. I mean, I remember my
Yeah.
economy class when I was a senior
Yeah.
was taught by, I mean, how are you supposed to
You had
learn
an
how to
economy
create?
class?
Exactly. Well, and it was
I didn't.
guessing, it was guessing stocks. It was guessing pennies. I mean, I literally for
Yeah.
one semester, all we did was go in every day and see if our stock went up or down. But how can
Yeah.
you expect someone who's making $50,000 a year as a high school teacher to teach you how to be wealthy in investing?
Yeah.
It's just silly.
Yeah.
Yeah.
I think
So
that is actually one of the opportunities that technology has brought us today, is you actually can learn from the people who have been wildly successful now.
exactly. And that's
I
why I
think Ray
believe,
Dalio is a great case in point.
yeah. Well, that's why I believe self-education is taking over so much, even compared to college. But
Yeah. Yeah.
yeah, what got you so interested in all these behaviors? What brought you into the study of all this?
I think I was always interested in it from the beginning. you know,
Yeah.
I just was always interested in um, self-knowledge
Mhm.
and self-actualization and trying to figure out how the heck the world works. Whether it be from studying philosophy to studying martial arts to trying meditation to eventually returning to a Christian faith.
That's great.
And getting my PhD. Like I really wanted to understand um, what was going on in mathematics, and what does it point to, and how do I use it in my life. And so I've just always been somebody who's been, I guess, a seeker.
Mhm.
And ironically, I have found investing and speculation to be an amazing vehicle and venue for self-discovery.
Love it. That's
I
awesome.
mean, I did martial arts, I did meditation, I did sweat lodges with Native Americans, I did all kinds of stuff, and in the end, I've learned more about myself investing than I have in almost anywhere else,
How interesting.
because you got money on the table. There's a quantifiable outcome, whether you succeed or not. So you
Mhm.
can't really, keep lying to yourself, because
Yep.
you'll run out of money. And ultimately, I think that going back to, early on in my work, they said, hey, you take the emotion out of investing.
Yes.
And I do think that there is something to that. But what I realized later on is that, I do take the superficial emotions out of investing, but there are deep, long-term, emotions that come along with mastery and success
Mm.
and intelligent risk taking and control that are much more valuable than whether you win or lose on one investment, right?
Absolutely.
And so that's what I see the opportunity, is for financial literacy, for people to reconnect to the value of capital allocation. If you are fortunate enough to have capital, or if you aspire to having capital, what you do with that capital matters. You are an influencer, and investing in the stock market, just as a case in point, is about more than just picking the right horse and betting on it.
Mhm.
You're actually influencing whether that company is going to be successful or not. You are giving your capital to that company to deploy,
Yep.
right? And it's part of you. So I think there's just so many dimensions to this, wonderful arena that people don't
Yep.
fully appreciate. And, I'm all about giving them the tools so that they can hold their own and stay in the game, and ultimately be a part of this for decades to come.
I love it. I feel like we could talk so much deeper on this stuff for probably another hour or so, but
Sure.
I would love for
Understood.
people to know how people can connect with Dr. Richard Smith. Where can they go? What can they expect?
Yeah. The best place to follow my work right now is at richardmsmith.com. So
Perfect.
I'm writing a book. I'm building new financial technology. Most of it I expect to start to be available in the fall of this year. So for now, if you want to learn more about my work and get a weekly update from me, you can follow along at richardmsmith.com.
Easy enough. Hey, any last words, Dr. Smith?
I would just tell everybody that this is a wonderful arena. It's, get in the game and be in it for the long haul.
Awesome. Well, hey, thank you so much for being on the show today and helping our audience to conquer the world of investing. We appreciate you.
Thank you, Kyle. Great to talk to you.
All right, show notes for this one, fearlesskyle.com/Richard Smith. And then his website is just Richard M as in Mary Smith. And you can go check out everything he's doing, his book that comes out in about a month or so, all the things that he's doing to be able to help make investing easier for you. And I think that there's just so many good takeaways today, but understanding your behaviors, what's holding you back from being a great investor, and how can you attach a system or an algorithm or a practice that takes the emotion out of it, that just strictly, the thing that he talks about with that trailing stop, 25%, not around 25%, but at an exact 25%. If it drops 25%, he's out of that stock. How can you implement that into your real estate business, your investing business, your Airbnb business, your life? How about your relationships? How about having those red flags that pop up and those things that you say, well, maybe I can let that go, and having a hard no on that? There's so many different ways in which we can take emotion out of things to be happier and more successful in every aspect of life. And that's what I loved about today's show. So comment on this. Let us know what you loved about today's show. We would love to be able to hear your thoughts. And we love, again, with you joining us every single time to conquer the world of investing. We appreciate you being on. We'll see you next time.